All right, everyone, thank you for attending and welcome to Real Talk Office Hours for this Friday, May 1st, May Day 2020. Quickly, just an introduction on Startup Grind. We are the world's largest startup community. We have 600 chapters in over 125 countries, and we operate with a mission to educate, inspire, and connect. Beyond that, we also follow three important values. First is make friends, not contacts. Help others before you help yourself, and then give before you take. And it was in that light that George came forward and asked me if I thought it'd be valuable and if I'd be interested in hosting an update on global markets and an expert roundtable where entrepreneurs and leaders could come and ask for actionable advice. And the fact is, the majority of entrepreneurs today didn't have to lead through the Great Recession. They weren't CEOs during the dot-com bubble. And they probably didn't even study the market crash in the 80s, let alone previous histories. So how are they to be expected to do anything but follow their guts or even the reactionary examples of their peers? In the world of alternative facts and fake news, we need to be informed, rational, analytical, and rigorous in our thinking. This pandemic has been and will continue to be the great leveler. This event series is meant to be an ongoing conversation, and I'd like to invite you to attend every Monday, Wednesday, Friday at 12 p.m. Eastern as we record these. And if you can't, then they'll be available on the startupgrind.com/grand-rapids website, and also on our YouTube channel. We're also interested in developing this into a global conversation, so feel free to please share the invitation with your colleagues and friends and invite them to participate. In the next weeks and months, we'll be bringing on some special guests, and we really look forward to introducing their perspectives into the conversation as well. Last bit of housekeeping before I pass this on to George is gotta make sure to mention that the comments made and views expressed by all participants in this podcast are not intended to invite or incite individuals, entrepreneurs, or investors to buy or sell financial assets, real assets, commodities, futures, and/or options. The purpose of this podcast is to educate and inform, not to trade or to invest. If you feel compelled to trade or invest, please call your broker. So with that, George, please go ahead and share your screen and get started.
Okay, may I please ask you to let me share the screen? Wonderful, thank you. Hello everyone, and welcome to Real Talk. What you see in front of you is the Bloomberg screen with the equities markets around the globe. Asia Pacific has closed. The Nikkei was down 2.8%. The Hang Seng in Hong Kong was marginally up 0.28. Australia was down 5%. And generally, the Morgan Stanley Asia Pacific Index was up just 1%. In Europe, markets closed negatively, at least 2% across the board, with Spain just closing at 1.9% lower. The US, as we speak, we see that the Dow Jones is down 2.5%, the S&P is 2.6%, NASDAQ 3.4%, and the composite index is actually 1.2% down compared to yesterday. You may recall that on Wednesday, after the press release by the Federal Open Market Committee of the Federal Reserve, the chairman of the board of the Federal Reserve, Jerome Powell, gave a press conference, and he highlighted the fact that the Federal Reserve will continue to support the economy in any possible way. On Thursday, we saw that the Federal Reserve, for the first time, extended credit to oil companies. This is significant. However, all this, together with the latest news, makes us wonder. First of all, we had Amazon yesterday reporting earnings. The share price fell more than 5% because the company missed analyst earnings. In its quarterly press release, Amazon said it would spend second quarter profits estimated to be $4 billion on responding to the COVID-19 pandemic. Quote unquote, if you're a share owner in Amazon, you may want to take a seat because we are not thinking big. We're not thinking small, Jeff Bezos said. The only positive news out of the Amazon quarterly earnings report was that AWS, Amazon Web Services, topped quarterly revenue of $10 billion for the first time. Apple equally did publish its own quarterly reports. The share price is still down today. The results topped analyst expectations. However, iPhone sales fell 7%. The company, of course, decided to stop giving projections going forward. On the other hand, yesterday, Boeing had a massive $25 billion bond issuance. It's different in different tranches, in different maturities. The most important of which was a 40-year bond maturing in 2060. In the retail space, we hear from the market that J. Crew is preparing for bankruptcy. Neiman Marcus is also in the process of filing for bankruptcy. And JCPenney is talking to fundraisers to raise $1 billion in bankruptcy financing. Tomorrow, we expect that Warren Buffett will release the letter to the shareholders. Berkshire is sitting on an estimated of $128 billion. This is massive. Let me continue to now the commodities area, please, and you will see that here we have, give me 1 second, please. Do you see the commodities? Okay. Energy, West Texas Intermediate. It's trading just short of $19. You remember we started this week at $10 overnight trading in Asian opening, then firmed to 13, and from then on, West Texas never looked back. Again, we are having issues with storage. May is a make or break period where most of the storage capacities seem to be filling up. Gold, $1,700, up and down between 1670 and 1740. Again, a lot of uncertainty about the monetization of the debt, about currency debasement, but also general concern about the future of the world economy is keeping gold in a tight range. Copper is a good indicator for growth. If you're looking at early signals of growth in the world economy, you should be looking at copper. Copper is trading at $230 per pound, down almost 4% today. On the agricultural side, I'm always looking at corn, wheat, and soybeans because these are important staples for the meat that we eat, but also for all kinds of other products. Corn is $317 per bushel, down almost 1% compared to yesterday. Wheat is down 1.6%, and live cattle is 2.9% up year on year. Remember, we have issues here with supply chain. We know that the coronavirus is affecting workers in slaughterhouses, and it will probably affect some of the availability of the product on the shelves as we go forward. But this could be a short-term effect. I would like to turn to bonds at the moment and start with Asia Pacific. As we highlighted in our Wednesday presentation, The bond market has not moved very far up or down across the board in emerging markets, in advanced industrialized economies as well. And the reason for this is because bond investors are concerned. 10-year yield in Japan is 0.04%, almost 0%. In Australia, 0.9%. New Zealand, 0.7%. Singapore, 0.9%. South Korea, 1.5%. And in India, 6.1%. In Europe, you see that the yield of the 10-year bond in Germany moved from 0.52 on Wednesday to 0.59 negative. That means investors are buying more of the 10-year bonds in Germany. That's why the yield is declining even further. In the UK, it is 0.24. France, negative 0.12. In Spain, 0.7. And Switzerland, 0.6. Again, the fact that investors are holding on to some of these negative returns on 10-year bond investments suggests that investors are concerned about medium-term economic developments. In the United States, the 10-year yield is again hovering around the 0.6% rate, Canada 0.5%, and Mexico 0.5%. Let me turn now to our calendar. Today was a busy day. In most of the world, people are celebrating International Workers' Day, which is fine. Here we had a busy, very busy morning. The final manufacturing PMI, Purchasing Managers Index, came at 36.1, below the forecast of 36.9. That is very important because the index, the manufacturing PMI index, reflects the business development in the previous month. And as you see, we have moved from 52% in 52 points back in January and February of this year to 36 at the moment. These are big declines and suggest that manufacturing is slowing down. The Institute for Supply Management is also another solid indicator. This is a survey of purchasing managers in the manufacturing industry, a good warning point. We moved from 50.9 in February to 41.5 today. Construction spending is again backward looking, 0.9%. We will see that actually being more problematic going forward. We also saw that 3.8 million people filed for unemployment. We are now at the level of 20 million people filing for unemployment benefits. These are big, big numbers. Corey and participants, this is the latest that we have on our review of the markets. And as we're closing our first week of presentations, I would like to return to a paper that, an article that Nouriel Roubini of the Stern School of Business of New York University published in the middle of this week. His paper was titled "The Coming Greater Depression of the 2020s." Reflecting our own skepticism and our own concern about the depth of this pandemic-induced crisis, Professor Roubini highlights 10 factors that are extremely important to take into consideration when we assess the current situation. The first factor to take into consideration is debts and defaults. As you will see in today's notes, at the end of it, we have a map that was generated by the economist. Can you see it? Is that clear?
I still see the Bloomberg screen.
Oh, okay. I'm sorry for a second. Okay, here you go. This is the scope of the problem. It was called by the economist. We have the largest economies on the planet. You see how we start on the left-hand side column in terms of debt to GDP and the composition of that debt. In other words, how much of that debt is held by central banks, foreign creditors, and other domestic creditors. On the right-hand side of this chart, you see what is the likely effect of this crisis in terms of debt issuance by governments around the world, and who is likely to be issuing this debt. Buying this debt is one thing, issuing it is another. Typically, treasuries issue the debt, the central banks buy it, and this is what we call debt monetization. We saw last week in the article by the Jackson Hole Economics, and we have shared it with all our readers, that monetization is taking place these days. So, for instance, in the case of Japan, we start with about 240% of debt to GDP ratio before the crisis. In other words, the Bank of Japan has been issuing debt to the tune of 240% of GDP to finance the slowdown that we've seen, the structural changes, the demographic issues that the Japanese economy has. Because of this crisis, the economists expect 15%, 15% increase of debt issuance in Japan, of which all of it, in other words, 100% of this 15% will be purchased by the Bank of Japan. Okay? Italy. Italy is a major problem for the European Union. Low growth, structural rigidities, and inefficiencies across the economy. Before the crisis, Italy had about 135% of debt to GDP ratio. The economist expects 21% increase in this ratio, of which 7%, about, in other words, 30% of this debt will be bought by the central bank. In the US, we started with a little bit over 100% of debt to GDP ratio as calculated by the economists, and we expect that the Treasury will issue another 22% of debt as a result of this crisis, of which the Federal Reserve will buy almost half. Okay, I will not go through the rest, but you see the drill here. Canada will also issue about 20% of its debt to finance the deficiencies in the economy. Out of all these leading advanced industrialized economies, Germany seems to be in the best shape. With just over 50% of debt to GDP, Germany is expected to issue no more than 9% of its GDP in terms of debt. So against this background, I want to continue focusing on what Professor Rubini has been mentioning, because I think it is important for all entrepreneurs and venture investors, essentially the real risk takers in this economy, to understand the global picture. We will see more debt issuance and we will see more defaults by individuals, by publicly quoted companies, by privately quoted companies. The second big issue is we have a demographic time bomb. And this demographic time bomb is our aging population and healthcare. We have unfunded liabilities in our healthcare system. it is very likely that some form of universal healthcare will be the outcome of this crisis. We need to find ways to protect every member of our society. The third issue that Professor Rubin is highlighting is deflationary risk. All risk takers at some point become risk averse. What is that point? No one knows, but it's predicated on their backgrounds. Some people are more conservative than others. People who left jobs are unlikely to go and buy expensive TVs or expensive cell phones or expensive cars. It is more likely that individuals will hold back spending. If this behavior becomes accentuated, we could well see reduction in prices. The fourth risk is currency debasement. As Professor Rubini explains, the more central banks buy debt issued by the government to fund deficits, the more likely the currencies are exposed to potential debasement. One of the reasons that we have the gold price at $1,700 is precisely currency debasement fears. Investors are afraid that currencies will lose value. Fifth risk, digital disruption in the economy. It is clear that we're moving in many areas away from a real economy to a digital economy, especially in service delivery. This is a massive disruption that will work its way through the economy over a longer period of time. It started a few years ago, but now seems to be accelerating. Deglobalization is another issue. Critical. We talked about it in our last presentation as well. We have changes in the supply chain. The supply chain change is going to affect the way businesses are run. Next, challenged by autocratic institutions. We have seen that this crisis was used by many governments, especially in the third world, to reduce rights of their citizens, and or they used access to technology to control the public. This is likely to increase. We heard the president challenge China about its access to doctors to investigate the pandemic. The World Health Organization is asking for access and China is holding back. Expect more on this front. On both Monday and Wednesday, we highlighted the risk of cyber warfare and terrorism attacks. This is a classic environment for individuals and or organized groups to attack through the web all kinds of sectors of the economy. Last but not least, this crisis highlights environmental disruption. Specifically, as Professor Rubini highlights in his paper, is that recurring epidemics are, like climate change, essentially man-made disasters born of poor health and sanitary standards, the abuse of natural systems, and the growing interconnectivity of a globalized world. Pandemics and the many morbid symptoms of climate change will become more frequent, severe, and costly in the years ahead. Thank you very much for listening. We can now take questions.
Awesome. Thank you, George. Just as a note to everyone listening, when you go to the website, the startupgrind.com/grand-rapids, the notes for today's presentation will be included for download, as well as a link to Professor Rubini's paper that George has gone through in the last few minutes. Now, George, I do have just a quick question for you here. Maybe not quick, but in reading that paper from Professor Rabini and trying to bring all of this down to what things look like, on any one of our local main streets, whether that is in Oklahoma City with Ann or here in Grand Rapids. When I was reading that, and then also against the new, and since then all the new announcements with the retail bankruptcies, can you speak to what it might look like when we just even walk down our block in the next months towards the end of the year? And then maybe the opportunities, because at the end of that paper, it had me thinking about the opportunities for mom and pop businesses as we emerge from this, despite losing a great deal of them in the beginning. Is that a clear enough question?
Yes, Corey, and thank you for asking this question, because this is really at the core of what capitalism is about: taking risk, okay? Calculated risk in this regard. I think that, again, first of all, I don't have a crystal ball in front of me, but what we do know is, as we have highlighted on our invitation, never let go of crisis go wasted, right? We use the crisis to learn about ourselves and about our environment. So as you have seen, Amazon Web Services revenue topped $10 billion for the first time. We know from our friends in India that internet traffic in India increased. This last month of closing down increased by 700%. The opportunity is twofold. One, to realize that most retailers had been working on a supply chain that moved too far away from the local community, and they're paying for it. I don't think it is unwise to expect that we will see more mom and pops weaving and clothing making in the Midwest and big urban areas where you have immigrant populations like New York, San Francisco, Boston, and so on and so forth. The textile, clothing, and the apparel industry is very resilient, and it is always looking for niche operations, as we know. So I think that the demise of this long supply chain coming out of Indonesia, Philippines, Thailand, so to speak, the sweat economies, is going to be replicated locally, where we will start using more of our products here. The same thing with the food industry. I think the food industry is going to change. The opportunities will be, as we have discussed, in innovative ways of producing meals at low cost and delivering them in a secure environment, or teaching people how to use the ingredients in a faster way, in a better way. Again, I want to highlight here Apron, that online food company, is nearly the end of its life. Is that good or bad? Well, there's an opportunity here. Look at the automotive industry. Some companies in the automotive industry, in the US automotive industry, are likely to suffer because they have not modernized enough and they have not followed the trend in mobility. Having said that, we need to think again about the supply chain that goes into all these products that we used to buy in a supermarket, in the market down in the center of town, and so on and so forth. Urban centers are likely to experience a decline to start with, and they will reach a trough and at some point a rejuvenation. Remember, we've seen this time and again from the late 70s, early 80s onwards. Because of the high concentration per square foot of individuals, urban centers become dangerous at times of pandemic. And as you've heard from acquaintances and friends in New York, individuals fled, literally. emptied the houses, apartments, and went to the parents, the families from Long Island elsewhere. This is going to have a long-term effect. And I'm already beginning to hear that some form of reverse gentrification is likely to happen. So as these houses become available, less expensive, we may see new individuals coming in who can now afford a better lifestyle, whereas before it was prohibited. To make the long story short, we are going to go through cycles of destruction and creation. As the Austrian School of Economics has said, the animal spirits of capitalism will destroy unwise debt and slowly, from the ashes, invest in new products and services. Schumpeter, it was actually the Austrian economist Schumpeter, who said that the animal spirits of capitalism are the major force in creative destruction and reconstruction.
Yeah, and we're already seeing a great deal of marvelous innovation currently, even this last few weeks. So with that, I'd like to open it up in case anyone does have any thoughts they'd like to contribute or questions.
No questions, just thanks for all that insight. Fascinating stuff, that's for sure. Yeah, albeit not very promising. But
Bernard, if I may ask, in what area of economic activity are you involved?
So we're a nonprofit responsible for economic development in Detroit. Or, you know, we're the Michigan Israel Business Accelerator, so we bring Michigan businesses and Israeli businesses together. So, you know, just checking in today as I met Corey earlier this week and wanted to see what this
if I may say so, your sector is going to benefit enormously because you will be the link between entrepreneurs and venture capital.
Right.
And you will see that your services will be required across the board.
Yeah, it makes sense. Yep. I'm hoping that that's the case. I do think it makes a lot of sense. So, yep.
The focus, I think, going forward should be to raise enough capital and to create a lot of communication in the state, but also across states, so you can create economies of scale because the opportunities are going to be everywhere. Thank you.
Yeah, thank you.
George, thank you again for this great first week. It has been very insightful, informative, and also entertaining as we pay attention, look outside, look inside ourselves and the opportunities, and really learn as much as we can, be driven by our curiosity to find the best facts we can find so that we can make the best decisions for ourselves, our families, and our businesses. And that being said, look forward to seeing everyone, hearing everyone on Monday and Wednesday and Friday, 12 p.m. Eastern time. And then later in the day, we'll be publishing these things for consumption and sharing afterwards. George, thank you.
Before we go, just one last sentence. Past performance is not a good indicator of future success. Okay? We have to remain positive, but be realistic. This is a long road. Thank you, everyone. Have a very good weekend.